And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition of The Real Investment Show. Danny Ratliff joining me this morning. A lot of questions we need to go through from this past weekend's Candid Coffee. So a lot of those questions that y'all asked, they didn't get a chance to cover. We'll try to get into some more of those today. Talking about private credit all the way over to annuities and, how does this all fit in your portfolio, et cetera. We'll get into some of those questions this morning. Markets today really at a make or break moment. Now we'll talk a little bit about more of this in a moment when we get to the before the bell report and we actually get to the technicals. But today is CPI day, so all eyes are focused on the Consumer Price Index report. Expectations are that it'll come in at about 0.3. That's a little bit lower than where it was last month at 0.4. So again, the kind of the key measure is will this be a super hot number? Will we see a lot of input going into that? And of course, this is always kind of the question. A lot of these numbers are looking at these numbers on a month-to-month basis really don't tell you a lot, other than it just tells you that inflation is volatile, which is what we know. Prices move up and down every month and things happen, like the whole situation with eggs right now because of the avian flu. There's things that feed into short-term price pressures, but the trend is what's important. It's like, what's the trend of the inflation? Where's that headed over the next few years? That's really what's much more important. But markets are all hinged on now, what's the Fed going to do, right? So every single report plays into what's the Fed going to do? Is this going to mean more rate cuts or more rate hikes? What's this going to mean? So, we've really kind of lost focus about how markets are supposed to work, and we're all focused on what the Fed's going to do. It's okay. It's just what it is. But today's report is going to be one of those key kind of factors. Then tomorrow we get the producer price index, which will tell us whether or not companies can pass on inflation to consumers. Very interesting in the earnings reports this season, right? We saw a good bit of conversation about worries about the dollar, the strength of the dollar. That's eating into exports, of course, because 41% of exports, or so 41% of corporate revenues come from exports. So if the dollar is a lot stronger, that means that foreigners can't purchase as much of the goods, right? So that impacts exports. So we saw a lot of concern about the strength of the dollar in fourth quarter's earnings reports. Well, the dollar continues to rally fairly strongly here. And again, it's fairly elevated, to its longer term kind of trend. And this is certainly kind of weighing on corporate profitability, particularly from the export side of the business. So, companies like Apple and IBM and Meta and others, they get impacted by this stronger dollar on services or products that they're exporting to other countries. Also too, it's very kind of fascinating here that, this dollar strength has been, all kind of belying. Remember a couple of years ago, it was all about the dollars, the dollar's going away, we're de-dollarizing, nobody wants the dollar, and we've had this exceptionally strong run in the dollar. And particularly that's a function because economic growth in the U.S. is so much stronger than everywhere else in the world. So again, that's been one of the key factors. Second factor has been just massive money flows, particularly from foreign investors into U.S. equities. So we've just seen a lot of money coming into U.S. dollar-denominated products, U.S. treasuries, gold, stocks. All those are just absorbing dollars, and that's increasing the strength of the dollar as well. And that's really been a big driver of markets here over the last, and again, whether it's stocks or gold or bonds, that's been a big driver of those inflows into those assets over the last years. There's been storing reserves in the U.S. Outside of that, though, when we start talking about inflation, one of the big drivers, of course, is that we in the short term. Now, in the long term, it's about the trend of overall inflation and particularly in the homeowner's equivalent rent, which is what is about 40% of CPI. So what happens there? And again, those real-time indexes are all in the negative category right now. So, but that has a big lag effect to get in. In the short term, things like oil prices are a kind of a good proxy about where inflation is. The problem, though, and again, you're going to see a lot of this headline that early this morning is like, if inflation comes as high as low, oil prices are up. And yes, oil prices have ticked up recently, but they run about a 3-month lag before it shows up in inflation. So this little uptick in oil really isn't going to feed a lot into the inflationary pressure. It's going to be this decline here that was occurring back in January, really kind of January in general. That's what's going to feed into, in December, that's what's going to feed into a lot of this kind of impact in oil prices. So when you take a look, kind of back, oil prices have not been a big inflationary push right now anyway, other than this little temporary spike that we had. That's still feeding into inflation. So again, the pressure on inflation is at least lower from commodity prices, but they do have an impact. So again, we could see a little bit hotter than expected CPI report today, but that's going to be due to more extraneous factors. Most likely, we're going to see housing prices continue to really kind of moderate lower, and that's going to be the big driver. So now let's talk about the markets, because the market is going to have a big response to the report today, one way or the other. Why? Because it's all about the Fed. So here's what you need to know before the bell this morning. Couple of things that we've talked about here just recently with the markets is markets have just been kind of in this hang out and wait mode here really for the last couple of weeks, but really the last couple of months. As we talked about yesterday, we've just been in this really, really big consolidation range now for the last 2 months. Really have not gone much of anywhere at this point. And prices just really kind of continue to just, despite whether it's DeepSeek or whether it was inflation, tariffs, on Canada and Mexico, or whether it was tariffs on aluminum and steel prices, the market just really has shrugged a lot of that off. And despite, these big concerns and headlines and everything else, and, had a lot of bearish headlines, so it was like, oh, this changes everything. Yeah, not so much. Markets just kind of keep just hanging in there. We've seen a lot of rotation within the markets. We've seen money go out of technology into financials and into healthcare. Now we're seeing money kind of rotate back in the other direction. But that's just the markets have just been really rotating through this. And the markets continue to really hold key support. Now, the one thing we're looking at today is the market is going to make a move in a direction today based on this CPI report this morning. If it's too hot, you're going to see a fairly decent move to the downside. If it's cooler than expected, you'll see a decent move to the upside. Now, importantly, though, right now we are in a very defined little consolidation wedge that's been going on. So we've been compressing prices. We've talked about this before on the show, that we've been compressing these prices and again, within a very narrow range. And they've been holding support, which is bullish right now. So if this report comes in a little bit cooler than expected this morning, we could see a significant, at least a decent move to the upside, maybe 1.5% today. If we see one that's too hot, we're going to probably take out some key support here today, and then we'll kind of see where the market settles after that, depending on that report. What is likely not going to happen is this market doesn't do a whole lot today, at least at the open. We may wind up flat for the day, one way or the other, based on kind of market trades, etc. But initially, after this report this morning, you're likely going to see a fairly decent move. But we're so compressed in price right now, we're probably going to break out of this channel. We'll see. We'll follow up on this tomorrow to see if that's indeed the case. But we've got a couple of things are going here. We do have some good support at the 50 and the 20-day moving average, which is sitting right below where prices are right now. The 100-day is sitting right around 5,900-ish. About 5,980. On the index. So again, there's some decent downside support. And then right at 6,100, we just have a whole lot of overhead resistance. And that's been the real challenge for this market over the last really 2 months, has been trying to get above that resistance at 6,100. We keep running into it, failing off of that. Depending on that report today, we may be trying to challenge the breakout of that resistance level to the upside if it's cooler than expected report. On the downside, keep a watch on 100-day moving average for the next level of support if we do break to the downside of that consolidation range. Again, just kind of be a little bit cautious here, and we'll see how things work out. We'll talk about it more tomorrow, but that's what you need to know before the bell today. When we come back, we'll pick up with Danny Ratliff, get into a lot of questions from Candid Coffee this past weekend, and hope that there's some things in there that'll take care of you. Be right back for more of the Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, Danny Ratliff joining me, and this is the Real Investment Show public service announcement. Friday is Valentine's Day. Do not forget that Friday is Valentine's Day. This is for all you gentlemen driving to work this morning. I know it's going to sneak up on you, right? Today's the 12th. 14th is on Friday. So if you want to have a happy weekend, be sure and swing by Kroger's and get your flowers.
Don't be that guy.
Hey.
Get it done.
Hey.
No.
Hey, Danny.
No.
Danny, we have to make it easy on these guys, right? Don't make it complicated. Now, Danny goes above and beyond. He goes to private florists. He goes and picks the flowers himself, has a private gardener that he works with. When you're the bulldog, I mean, you can do these things. From his book sales alone, he can afford, all these luxuries in life. But for us regular guys, the Kroger flower tent will work just fine. But
you want to know a secret?
Yeah.
We don't celebrate that crap. We made a deal years ago. Look, I will surprise you with flowers. They're likely not going to be the expensive ones.
They're from Kroger's.
No.
Randall's.
No. But, well, you think about it. I mean, what a hoax. I'm going to go spend all this money for one day. Listen, I'm going to treat her like a queen 365 days a year. She's going to get what she needs. And I will surprise her with flowers, not when somebody tells me I have to.
Danny,
and spend triple and quadruple.
Danny,
no.
I don't agree with you often, but I will agree with you on this, that Valentine's Day is a Hallmark con, right?
Yeah.
So
no. I'm not going to go buy, spend $100 on flowers I can spend $10 for in 3 days later,
But just to keep this real, gentlemen, don't forget, if you want a happy household.
Yeah. Now, I do have a deal, so let me set the table here. We've had this discussion. This isn't something where she's expecting a lot of,
pomp and circumstance.
Yeah. She knows. This is just not something that we're going to be suckered into. And now we'll like with the kids, she wants to do things for the kids, and we'll cook a nice dinner for them or something. And we've had it where they can be the waiters and waitresses or the chef and let them have some fun with it. But I refuse to get caught up in that.
Gentlemen, do not take Danny's advice on this.
Unless you already have. Now
if you've had this conversation and you have this agreement in writing, gentlemen, this must be in writing.
Amen. Well, and know what you're dealing with, right?
Exactly.
I mean, there are some women who that's their love language and that's what they want.
I'll tell you this. So I put out. I'll read you the tweet I put out on X this morning. There was a article out, or actually a survey out this morning. Let me see if I can find this chart here real quick, and Brent can put it up so you can see it. And what it shows, here it is right here. So this is a survey that was done asking Americans how much they plan to spend on their significant others for Valentine's Day. Gen Zers look to spend the most, around $257, followed by millennials at $247. Baby boomers look to spend about $89. And the tweet I put out this morning, I says, this is the best part about being old and married to the love of your life. Me. Hey, babe, what do you want to do for Valentine's Day? Her. Take me to dinner or lose me forever, you stud muffin. And that's a line from Top Gun if you don't remember the movie. But yeah, that's it. That's our whole deal for Valentine's, is that we just want to spend a few hours together, and so we'll go out to dinner somewhere, and that's it.
But you need to do it like today. That's the key, right?
Actually, we tried to get reservations for Friday night. So she's traveling all week. She's in Dallas at a power gen convention, And so she'll be back on Thursday. So I tried to make reservations at her favorite restaurant for Friday night, completely booked. It's a real small restaurant, completely booked. So we are actually celebrating Valentine's on Saturday.
There you go.
So,
see, that's the way you got to do it, right? You got to kind of get around all the, the rush.
Yeah, I mean, when you can't get a table at 4:30 in the evening, it's busy.
Man, I am just shocked that Luby's was that stacked.
It is. They are backed up. They are actually backed up. Actually, her favorite restaurant is Lynn's Steakhouse on Derry Ashford. It's been there for like 300 years, I think. It's a very, very small little steakhouse restaurant, and she loves it. So and this is how old it is. She was going there with her dad as a kid. That's how long that steakhouse has been there. Yeah.
That's impressive.
So
it looks like it when you drive by.
It does. It looks terrible on the outside, but inside's very nice and the food's fantastic. So anyway, enough of that. Just don't forget Friday is Valentine's Day. That was all this started out, and Danny derailed the whole show. So
hey, this show's about money, and in the interest of your finances, think outside the box here. You don't have to be backed into a corner here.
Yeah. Just make sure, look, there's two ways to save money on Valentine's Day. Have the conversation with your wife or don't and wind up divorced. But either way, you're going to wind up saving money.
It's funny you say it. I was talking to some buddies with younger kids, and they're like, yeah. I was like, what are the kids doing? And they're like, well, they usually break up before Valentine's Day. I'm like, really?
I told my son that story when I was young. I would do that. I would date and I would break up right before Valentine's Day and then get back together with him after Valentine's Day.
Lance, if in that stage, just called. Never mind.
Yeah.
Oh well.
I was much younger in life. I was much longer in life. Anyway. So this past weekend, Danny and Richard had their Candid coffee. Have you posted that video yet online? It is on that Candid coffee is posted up on our YouTube channel. So if you want to go peruse all the conversation they had, they cover everything from Medicare to Medicaid to Social Security to, kind of all these pending things in retirement outside of just investing. So that is up on the YouTube channel. Just go to therealinvestmentshow.com and that's there. But there was a lot of questions they couldn't get to, and we kind of touched on a couple of these yesterday, talking about kind of generating some income. And again, a lot of the questions that often get is like, well, I just buy dividend yielding stocks, and that's great until something goes wrong, and it happens. And so you don't get around the risk, right? There's no safe investment outside of treasuries. There is no safe investment. Actually, that's incorrect. Outside of treasuries and government National Mortgage Association bonds, which are all government guaranteed, there's no what's considered a risk-free investment. Everything else has a risk to it. So it's always important to understand the risk that you're taking for the relative return that you're getting. And whilst investing in high dividend stocks sounds great, it's great until something goes wrong. Now, nothing's gone wrong in 15 years, so everybody's kind of forgotten what happens when something goes terribly wrong. But if you've been in the markets long enough, you will remember that when you're going through a financial event of some sort and you're losing 30, 40, 50% of your principal, all of a sudden the yield's not so attractive anymore.
Yeah. And we had a lot of really good questions around that. And so we kind of bounced around quite a bit. If you don't know, Candid Coffee is just kind of, we just answer questions. You can send them in prior, you can ask while we're there. And so we didn't get to everything. And so wanted to spend a little bit of time today. I think the dividend yield aspect is always a hot topic. And especially once we begin to get a little volatility, I begin to get a lot of articles from people and they're saying, oh man, look at this. These companies have their dividend percentage has always increased in bear markets. I'm like, well, yeah, that's a function of math. They may not have cut their actual dividend, but if their stock depreciates, their percentage of income is actually going up. Right. And so I think there's a big misconception around that I think it's difficult for a lot of people to understand because we read these articles and they may be a little bit misleading in the sense that, oh, wait, that's great. Their dividend was not cut. Their percentage actually did go up, but that's not necessarily a good thing.
Right. Well, again, and it's very different. And again, I can tell you this from personal experience because, I've been through the dot-com crash, 87, 2008, been there. And it's always interesting because we say, well, I own this stock for this dividend. And then when 50% of their capital is gone, all of a sudden that dividend doesn't matter so much. And then, of course, the other side of that is if you're in the middle of a financial event, a lot of those dividends go away. And
Yep.
so all of a sudden that yield goes to zero very quickly. We covered a lot of that yesterday, so I don't want to rehash it. We got a lot of other questions
Yep.
to get into this morning. But, pick one where you want to start.
Well, I think one thing you did mention is like on treasury yields or even agency bonds in the sense of there not being any risk. And maybe from a default perspective, there's not. But there's that duration or the reinvestment risk I think people need to be considering. And, we did get a lot of questions surrounding duration. And so, what does that look like? Should you be investing in a mutual fund, an ETF, a actual physical bond? And then what's the difference between like a 1-year bond versus a 6-year in the sense of, okay, number one, obviously it's going to be interest, yield. And we've seen that inverted yield curve. We're beginning to see changes surrounding that. It's kind of gone back and forth quite a bit. But, I think that the understanding of you need to understand there's going to be some volatility still associated with these positions. And some people don't care. They say, it doesn't matter. I'm going to hold this until it matures. I'm going to collect the income that it's going to pay me. No big deal. I don't care where it is, but my principal will be returned at the, when this bond matures. But for a lot of other people, there may be a speculative aspect to it or the growth component. Right. And that's when you want to go further out on duration. Right now, I think the challenge could be is, I've talked to a lot of people last week, and a lot of the questions that we got were like, why aren't we just going and buying, 6-month bills? Well, you can, but at some point, if we do believe that interest rates are coming down in earnest, what's that reinvestment risk? Where are you going to be? If you can go get something at a little over 4, and now is it going to be 3 in 6 months? Is it going to be in a year or 2 years? So let's talk about that on the other end of the break on maybe how duration looks and what people should be considering.
Yeah, and it's a good point, real quick. Just, when I say the term risk-free, in the investment markets, there is nothing you can say as financial advisors that is guaranteed returns or risk-free investments. The only thing that is considered risk-free are U.S. Treasuries, and that's because they get paid, right? So, but that's just more of a nomenclature when you're comparing yields.
Yeah.
So, all right, be right back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the health care insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife likes to open up the house. She had this idea that said, hey, can we just put a little black fence around the porch? And you have to submit all this to the HOA.
The Real Investment Show podcast.
They sent back this letter. The fence is disinharmonious with the neighborhood. Not disharmonious, not inharmonious. We had to get it all in there. It was so inharmonious that we had to do disinharmonious.
That's our word for the day.
Yes, disinharmonious.
Same show, your schedule.
So what are you going to do?
We're going to put bushes up.
And then put the fence up.
And then put the fence up. I could just say it was there to help the shrubs. Good idea.
Topiary support.
Topiary support. I like it. I like this a lot, actually.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show. Just trying to get through some of these questions that are out there. We're just kind of finishing up a little bit about talking about duration, particularly when it comes to bond portfolios. And again, duration is a function of not just, generally when we talk about duration or bonds, everybody just assumes we're talking about treasuries, but that can be corporate bonds, it can be high yield bonds, it can be, anything in the fixed income world, collateralized loan obligations, mortgage-backed securities. You can get duration however you want to get there, right? There's lots of different M&Ms in that particular bag of bonds to choose from.
Yeah, and I think that, understanding the duration it's a little bit different for everybody. Number one, your risk appetite, what you're trying to accomplish from a goal perspective. And then, we need to think about, one of the questions was buckets of money. Like the old Ray Lucia, do you remember that? Mm-hmm. Where it was, okay, we want to have this bucket for this purpose. Another bucket's going to be fixed income. The other bucket's going to be your long-term. So kind of a cash fixed income stock portfolio. Now, I think that most people already do that. They don't segregate it maybe exactly the way that he was mentioning it. And this was many, many years ago. But thinking about even your fixed income bucket in general or your income bucket, number one, diversification can be really good. It could be bad depending on what you're in. But I think that, when we think about duration in general, what are the funds intended for? If you have that cash bucket, does it all really need to be pure cash? Can you look at putting funds into something different? Is it a bond ETF, something similar to, a short-term treasury? Or is it actual treasuries or other types of instruments that you can accomplish maybe a little bit better yield? And so that's something that, as you have funds that are maybe they're for taxes, or you're going to buy a new home, you're going to take a trip, whatever it may be, it doesn't have to be pure cash. But you may also say, well, look, I'm not doing that for 3 years, and maybe it's not the place, the market's not the place for those types of assets because you can't face a significant decline. And so when we begin to actually put the pen to pad and get a good understanding as far as where funds should be going, you can kind of create that strategy on your own, but then that'll also impact your duration kind of conversation for yourself in the sense of, how long should it be? Now, you may have some that is extremely long in duration, but if you're in the camp that you think rates are going to decline over time, you want to get appreciation with it and, lock in some yield, that's great. But you also have to understand that if rates pop, your duration on something, take a 20-year ETF, are probably going to be closer to 16, 17, 18%. So meaning that duration is just a measure of volatility to a change in interest rates. So if your duration is 6 and you see that rates go up by 1%, your position is going to decline by 6. Now, on the flip side, because it has that inverse relationship, meaning that if interest rates go down, your net asset value will increase because your bond is going to be selling at a premium. It's going to be more attractive. So if your bond is paying you 4.5% and rates are now on that same type of bond or at 4%, people will want yours because they say, look, I can lock in a higher yield for longer, which many people look at that fixed income for strictly the income that it can provide, the coupon. Mm-hmm. And I think that's where things have changed a bit too, just with how people have traded. Now we see people getting in fixed income to actually trade it, right? Where they're getting in and out more frequently, kind of what you do with the stock. Mm-hmm. And so the mindset has shifted where I think 10, 15, 20 years ago, most people bought fixed income with the intent to hold it till maturity.
Yep.
It's
Absolutely.
a big difference.
It's a huge difference. And in fact, there's whole groups now that have just read an article yesterday. They're trying to figure out how to bring the bond market into the quote unquote digital age to where you can trade bonds just like you trade a stock. Basically just look them up online, day trade them, however you want to do it. So again, there's lots of liquidity there, which potentially leads to higher returns for trading, short and long. So, but again, that's just going to reduce a lot of volatility, more volatility to the bond market eventually if that occurs.
Yeah.
Real quick, I'd like to get to this one question about about creating income. It says there's actually two questions. I'm going to blend them together. Have you given a serious look at the NEOS income products like SPYI for clients who want tax efficient income, or covered call funds like JEPI, which is the JP Morgan Equity Income Fund, as a good replacement for fixed income? And it's very interesting. So first of all, these funds have not been around very long. These are an advent of the market because we now have record options trading in the markets right now. In fact, I just posted a chart this morning on Twitter talking about this very same thing. And again, this is just a picture of the kind of speculation that's entered the markets, particularly over the last 3 years since we really did these stimulus checks to households and everybody started kind of gambling in the markets, and we turned the markets into a casino. Options trading has just exploded. Well, that's good for funds that trade options, because if I'm buying a lot of options, that drives up the premium of the options on the upside. So if I'm writing covered calls, this surge in options volume of people buying long calls is increasing the premium of those funds. So when I'm writing a covered call against my Apple position as an example, I get paid more for it. So that helps bring up the yield of these particular funds. And so, for instance, like SPYI, it's or JEPI, either one, that's basically some underlying stocks of the index, and then they write covered calls against them. And they, like, for instance, SPYI has 11% yield, and you go, oh, wow. I can get an 11%, I can get an asset with an 11% yield. That's not risk-free. Again, if something happens in the markets and all of a sudden those options volume dissipates, which it will, all those premiums go away with it. So that 11% yield has become 1% very quickly. Because there won't be any options premium to write on the downside when that occurs. So covered call writing programs are great in an up market, particularly one that's very speculative in nature. Doesn't work so well in reverse. But more importantly, what are you giving up? See, this is the big question. What are you giving up by owning that fund? Great, I'm getting an 11% yield. Well, here's a chart of SPYI versus the S&P. So the S&P has, and let's just call it, make this thing kind of rough. The S&P has a 2% yield. SPY has an 11% yield. And you go, oh, wow, I can get that? That'd be great. I'm getting a 9% yield over the S&P. But you gave up roughly 10% return by owning SPYI versus just owning the S&P. So yes, you got the income from the yield, which again, the yield is just a function of the dividend being paid out by the price. So if there's a big crash, that's not going to help you very much. But you actually just grossly underperformed. The same thing occurred, and again, these funds have not been around very long. They are not battle tested by any stretch of the imagination. Most of these funds have been around just a little bit longer than a year. So they haven't been tested in a down market. But here's JEPI, sorry. Which is basically the same thing. This is a JP Morgan Equity Premium Income ETF. Its performance is even worse. So yeah, it's great that you're getting these outsized yields, but you have to go back and go do your homework and say, what am I giving up for that? Because I'm not really giving up a lot of volatility. I'm not getting a lot of reduced volatility to own these things, but I am giving up a lot of return. And particularly in an up market that's like we have right now. And again, we haven't seen these perform in a down market yet. Once we go through a nice 20-25% correction with these, like we did in 2022, we'll have a much better idea of whether or not these are viable investments or not.
Well, that fund in particular wasn't even started till August 30th of 2022. So it really missed most of that volatility.
That's right.
And, I think that's the exact point you're trying to make, is that they're not being battle tested. Where do you find something that maybe has a little bit more
history to it?
Yeah. And so what would you do maybe in lieu of that?
Well, I'm just saying, it's like, if they're everybody's absorbed by the yield, right? Oh, it's pays 11% yield, but you're giving up 11%, 10% of your return. So you didn't really get anything, right? You're not benefit. You're just better off buying the S&P index.
Well, the only thing you got was a tax bill at the end of every year. You couldn't control your taxes if it's outside of a retirement account.
Correct.
Yeah.
And that's so. But again, at the end of the day, if I'm winding up in the same bucket, return wise, kind of what's the point? And again, I don't know what the risks are to that. So anyway, just it's always and look, I'm not saying these things wrong with these. These are fine investments. They're just not battle tested yet. And I think you just have to be patient and wait, let these go through a correction at some point, see how they do, and maybe at some point that they really stand up to their measure, and they really wind up outperforming the S&P. Great. I've got no problem adding them. We'll add them to our portfolio if they do that. But right now, just the question is have you given a serious look? Yes, we've given a serious look to these. The reason we don't use them is specifically for the reasons I just laid out. Doesn't mean we won't use them in the future, though.
Well, what could you do, outside of that? So if you just wanted to do covered calls, wanted to do,
Yeah, if you own a basket of stocks in your portfolio, right now is a great time to write covered calls. Buy puts on the VIX because the VIX goes down most of the time. There's lots of things you can do with options. But the problem with options, Danny, is that they are the highest risk investment because they're binary. Either you make money or you lose everything. And this is the one thing you have to understand about options is that their leverage on your portfolio, and a lot of investors are trading options and they're doing 0-day options and these type of things. These are very binary bets. They will either make money or they will lose everything because options expire worthless. So you don't get like some of your money back at expiration. You either get a lot of money or you get no money. But again, this whole surge and options trading really started post the pandemic. And we have not been through a real market downturn to where all these options that people are betting on all wind up worthless at the same time. And that's coming. And the amount of wealth that will get wiped out in the next downturn from those type of investors is going to be enormous. How do I know? Because we've seen it in 2008, 1999, 1987. We've seen this before. We know how this story ends. It's just a function of time till we get there. All right, quick break. Come back. Got some more questions to get through. We'll get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now,
Another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Credit first. So just going through a few of these questions that we got from Candid Coffee, because it's probably stuff that maybe you're thinking about that we haven't covered on the show before. So, it might be a good idea. I thought one that was interesting, Danny, was talking about, alternative investments. Again, this is kind of a thing that more and more people are becoming aware of. They're becoming a lot more mainstream now. And high net worth investors, if you look at how high net worth investors allocate their capital, about 20 to 30% is in real estate, not their primary residence. It's real estate investments. About 15 to 20% tends to be in alternative investments, about 20% in stocks, and the rest in bonds. So, that's, and again, this is, kind of how they do it to help diversify risk. And so, things like private credit, real estate, those type of things, they can provide a good diversification to your portfolio, lower overall volatility, and can provide you, very nice yields between 11, 12, 13%, depending on, kind of what the investment is. So, those things are certainly optional, certainly available. You generally have to be what's considered either a qualified purchaser or a high net worth investor to get in those funds. Generally, minimums are between, $250,000 to $500,000. Sometimes they're $1 million to get into these funds. But if you are a high net worth investor, and we, just as a good example, we're in the process, we should have by the end of this month or early next month, we're launching a private credit real estate fund just for this reason. But if you have that availability, it is certainly a good way to diversify your portfolio into some assets that can create return, lower volatility, and provide you kind of a lower beta, so to speak, in your overall portfolio while maintaining your return structure.
Well, and I think there's a lot of things that people need to keep in mind when we're talking about some of these different types of investments, especially with alts in general, is that there's lots of different liquidity issues that could arise from something like this, that you don't have the same access that you'll have to your funds as you would if you had it in a fund, in a stock, a bond, whatever it may be. There's some illiquidity to it. So you need to understand the provisions of when you can actually distribute funds. And even then, if they have them, they may have a gate that says, hey, we're only going to let 5% out. Then we're going to shut that gate. And if you're not the first to the exit, you're stuck. So when we're thinking about funds like that, make sure you have a clear understanding as far as what your exit strategy is. How do you get out? This is never something that you would put the bulk of assets in. This would be, like Lance mentioned, a diversification tool, something to, potentially get higher income, to find different ways for appreciation, to have access areas that maybe it's a little bit more difficult in the public market. This is a way that you could do something. Right. And so, that's, I think, something that many people misinterpret.
Yeah.
Like, they'll let me get out once a year or once a quarter.
And some of them do.
Well,
again,
they do until they don't.
You have to just read your documents, and again, if you're in a high quality fund, you do have some liquidity. But to your point, though, it is much more restricted liquidity, which is why these funds are relegated to high net worth investors. Because if you've got the ability to put $500,000 or $1 million into a fund, then you've probably got lots of other liquidity. Again, you take a look at high net worth investors; they only have 15 to 20% of their total net worth in alternative investments. And they've got 20% in stocks, which are liquid, 20 to 30% in bonds, which are liquid, and then real estate investments, buildings, apartments, whatever, those are not liquid, right? So you've got long-term. So again, that's to your point, there are liquidity issues that should not be a bulk of your portfolio, but it can provide a really good diversification.
Yeah, and so, the other thing, though, is like we were talking about with fixed income in general. The same thing's happening in private credit, where you can actually go out and buy a fund that you can buy in your Fidelity account, and it's going to trade just like anything else would. But there's still potential liquidity issues with even those. And so just buyer beware. I think there's a lot of opportunity there, and this is a great way to access other markets that maybe you typically would not have access to. But make sure you have a very good understanding as far as how that works, what it looks like, what are your expectations for the funds? Because, while they do have these specific requirements you need to meet, like you need to have X amount in income, X amount in assets. We do see people try to get around those and try to put as much as they can in some of these. Just like you see with an annuity, like you should never put all of your funds into an annuity. And what do you see?
Yep.
I mean, I guarantee we could turn on a radio show this Saturday and there'll be some guy saying, "We put it all in an annuity. Don't worry about it." Oh, you've got a 401k. Put everything you've got.
Yeah. No, and that's very true. Again, this just goes back. And look, let's just touch on annuities real quick, right? Nothing wrong with annuities. They get a bad rap because a lot of times they're sold, they're not planned for, and annuities have a very important place within your overall financial structure. I was just talking to a young gentleman yesterday. He's just gotten a new job. He's making a lot of money. He's young. He's got 4 kids. And he's like, I need some help managing my money. I was like, man, you got much bigger issues you need to consider. You've got to start thinking about your estate planning, your insurance, and all these other type of things. And these are things that nobody really wants to talk about. And, in the financial world, they're quote unquote kind of taboos, like, oh, the guy's trying to sell me insurance products. There's really, and they're kind of got a bad rap because they were sold for bad reasons. But they're a very important part of your overall financial structure, and they need to be included in your whole plan. You shouldn't have all your money just in the stock market or just in gold or just in bonds or whatever else. You should have, some of all of these assets and all these different structures to make sure you can weather big events in the markets when and if they do occur, or, something happens to you and your family's taken care of.
Well, those annuities, I think, in general, there's a handful of reasons you'd use them. And I think that most people are confused because there's so many different types. And as you mentioned, they're not planned for, they're sold. And it just shows Lance does like financial planning and he does listen.
I have an annuity. I have life insurance.
Oh, I know. But you give us so much grief when we talk about these things because you say it's boring.
It is boring.
Yeah.
I fell asleep 4 times on Candid coffee. That was while I was drinking coffee.
I know it's not true. But it helps you sleep at night. That's fine. So, anyways, as we were saying, but there's so many different reasons. So if I want to look at an annuity, we're going to look at many different types for a different reason. It needs to fit the bigger picture. And so, it's either going to be, you could look at a multi-year guarantee, which is going to be similar to like a CD as far as how it operates, going to pay you a fixed interest rate. That's one that we've seen more and more people kind of move towards because they're paying a little bit more at the moment. A single premium immediate annuity, you could take a fund from pensions or a lump sum or retirement, or maybe it's that, hey, you want to bridge a gap from now until you reach 70 because you want to defer Social Security and say, okay, well, I'm 62 now. I want income for 8 years. It's going to offset, our expenses. You could put a specific amount aside, or maybe you look at it for longevity. You want something that will pay you and your spouse for the rest of your life. There's so many different ones. I mean, we got fixed indexed that we want to look at more for income generating, way further down the road. They're more considered like a deferred annuity. But they can be a great tool. And as Lance was mentioning, just from a diversification standpoint, from a longevity perspective, maybe it's just a higher income. You may want to use some you can attach a death benefit rider to it that's going to be there for your spouse or your kids. But in general, these are things that need to be done within a broader financial plan. And that plan will provide the roadmap for a lot of these conversations and questions that we received, because then we can back into what do you need? How do we need to get there? How do we structure something specifically for you and your family? And that's something I think is so often overlooked, where we just look at, like we were talking about that INEOS fund. They say, oh, shoot, look at the income it's going to pay versus, okay, how does it work? How does it fit within all the rest of my assets?
Right. And again, this goes back to, you had a question on, just want to hear about alternative income streams. Well, these are alternative income streams, right? Private credit, private alts, private real estate, annuities, insurance. These can all provide alternative income streams outside of just stocks and bonds. So again, this is why it's part of, your overall assessment. And again, I've talked about this before on the show, is that, again, every investment is a bad investment. if it's used improperly. And every investment structure, whether it's a mutual fund, mutual funds, as an example, get a bad rap, right? It's like, oh, it's a 5-letter mutual fund and it has high fees, and it's not necessarily a bad tool if you don't really know how to manage money. And if you've been in Fidelity Magellan since 1990, you're rich. So it's just no tool is a bad tool. It's just if it's used improperly. I can drive a nail with a screwdriver and it's not going to work very well, but I can get it done. Or I can use a hammer, right? And so it's just a function of using the right tool. And all these products that are out there and all these different things are just tools that can be used. They're in your toolbox, and you just need to learn how to use them and use them properly.
Yeah, I think that, when you're talking about mutual funds, like we don't really use mutual funds. In fact, I can't. What has it been? 6-7 years now, maybe since we've had one.
No.
We got one in one portfolio.
We have in our all-weather portfolio, which has our gold and everything else in it. We use a mutual fund in that because of its allocation structure of assets that we can't buy.
Correct.
Yeah, but
outside of that,
we don't. No, and then, it's fair because in our equity models or our other portfolio ETF models, we don't use mutual funds because we're layering fees and we don't want to layer fees on our clients. But in this particular case, this one fund we use has access to assets that we can't buy on the open exchange because it holds foreign assets. So we use the fund. The fund manager is awesome. They have great returns, so it's worth paying the fee to have access to those assets that we can't get into.
So, but that's more niche oriented.
Yes.
Like you may have a 401k and you may not have any other options within that plan. And so,
correct.
Yeah, mutual funds, that's going to be okay. But if you want to provide somebody where, look, you don't have boots on the ground, maybe it's international, maybe it's an alternative market. Mm-hmm. There's not, if you find a good manager, a good track record, I don't think that's a bad option.
It's not bad at all.
But just be cautious because fees can add up quickly.
Right, and that's how they get a bad rap.
Yeah.
In the media, right? It's like, I can't believe you buy a mutual fund. They charge 1.5%.
And they never beat the index.
Correct.
Well, of course, because there's fees.
Yeah, exactly. Thanks, Danny. All right, wraps up the show for the day. Be back tomorrow with Michael Leibowitz. We will get all into the inflation report that goes on today, what that means for the Fed and the markets, and we'll get into all that in the morning on the next issue of the Real Investment Show. Have a great day. See you back here tomorrow.